Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to another ChrisMartenson.com podcast. I am your host, of course, Chris Martenson, and today we have the distinct privilege of speaking with James Turk, founder and chairman of GoldMoney, which offers investors an easy and inexpensive online solution for buying precious metals with international storage options. James is one of the foremost authorities on precious metals and has long offered market forecast commentary, including co-authoring The Coming Collapse of the Dollar and How to Profit from It with our good friend John Rubino of DollarCollapse.com. He's built his career on decades of experience in international banking and finance, spending many of those years living outside the U.S., which gives him a critical advantage to look at our economy with an outsider's eyes. I'm really delighted to have you here, James, and have a tall stack of questions prepared for you. Are you ready to dive in?
Yeah, sure am, Chris, and it's a pleasure to speak with you.
The pleasure's mine. So, short term, what I'm really interested in here is to start diving into where gold is going to go short term. You know, where do we buy gold? We buy it now. And so over the short term, people are very concerned about the price of gold and where it's at and where it might be headed. So with QE2 ending here at the end of this month, we're in June right now. How do you expect the precious metals to be impacted?
Well, I think the precious metals are going to do quite well this summer. And I don't agree that QE2 is going to end in June. It may end in June, but it's not going to end on August 2nd, because on August 2nd, the U.S. government's going to increase its debt limit probably by $2 trillion. And the Federal Reserve is going to have to step in and start buying some of that government debt and run the printing presses again with all this new money creation. And I think that's what is going to light a fire under both gold and silver this summer.
So you're of the view that QE 3 is a done deal because they're in something of a box. The federal government has enormous borrowing needs, and you're of the opinion that really, without the Federal Reserve being there, there's insufficient buying power for all the borrowing needs they have? Yeah,
that's exactly right. I mean, look at what's happened since August of 2010 when the Federal Reserve announced QE2. During that period of time, up to the present, the U.S. government debt has increased about $900 billion. Mm-hmm. About $500 billion of that has been purchased by the Federal Reserve. You know, what's happening is that the U.S. government is spending so much money, it's forcing it to borrow more money than the market is willing to lend to it. And when that happens, only two things can happen. Spending has to be cut back, or the Federal Reserve steps in and buys that government debt and turns it into currency. And that's what QE is all about. And this policy of buying government debt is going to continue once the debt limit is increased after August 2nd. So, maybe the Federal Reserve will claim victory and say that they're going to stop QE on June 30th. But the reality is it's only going to happen until the debt limit increase isn't approved. And I do believe that at the end of the day, despite all of the posturing we're seeing now, the Congress and the President are going to approve a $2 trillion debt increase by August 2nd.
So really we're talking about July as a possible pause. And I have my concerns about that because we're looking at the data here in the first week of June roughly, and what I'm seeing is a lot of weakness out there. The Fed's so-called mandate around employment, around economic growth, there's a lot of weakness in that data right now. So you're of the opinion that QE, if it does pause, will only maybe for a month?
Yeah, maybe for a month unless Congress finally chooses to act sooner than August 2nd, although I don't expect that to happen. It's really just a question of numbers and mathematics, Chris. The U.S. government has to stop spending so much money, or the Federal Reserve has to come in and turn that government debt into currency. Those are the two alternatives. And I don't see any discipline or intent by Congress to stop spending.
Yeah, everything they've done so far is a bit of a dog and pony show without much substance. 30 billion, 90 billion, please. That meaningless at this point. And when we go over to the other side of the pond, we see that Europe also has just extraordinary funding needs right now. They're using all sorts of fancy terms for a Greek default, which will probably be the first of several shoes. But when you add it all up, it looks like there's, again, enormous funding gaps there and a need for a massive amount of liquidity. What's your view of Europe then? Is Europe going to print the ECB? Are they too in a box, or will they actually go for the austerity and allow the chips to fall where they may?
No, they've been printing all along, and in fact, I think they're going to continue to print as well. You know, the turning point here in Europe was really last May 2010, when the politicians got together when the Greek crisis had erupted and became quite serious. And on Monday morning, after the politicians met, Mr. Trichet, the president of the European Central Bank, said that he's going to start buying Greek bonds, despite his pledge not to buy sovereign debt of any country, and despite the fact that it's against the EU constitutional principles for the ECB to be buying any sovereign debt. You know, the law is basically just being ignored. It's being ignored by 13 of the 16 Eurozone countries who have debts exceeding 3% of annual deficits exceeding 3% of GDP. So it's basically, you know, the rule of law is basically out the window. Money printing is the order of the day. And when politicians take control of central banks, which they've done in the United States and are also doing in Europe, that basically destroys the currency. It puts the currency on the road to what I call the Fiat Currency Graveyard. And so I, expect that there's going to be some massive currency problems as we go forward. The financial crisis that we've been dealing with for the last several years, it has not been solved.
I agree completely, and so similar dynamics in both the U.S. and Europe, also Japan. Let's not wade into that too much. But what we see is the advanced developed nations all pursuing the same rough policy, which is to try and print their way out of the great credit bubble that they all got enmeshed in. So let's switch then to the end game. So you agree, I think, if I can put it this way, that the political will doesn't really exist, or the structural or institutional processes aren't really there to enforce any sort of true austerity, that printing is the path of least resistance, always been true historically, probably today is not different in that regard. Given that, what do you see as the end game here? Many call for a deflationary collapse or crunch, and other people call for an inflationary, and some call for hyperinflationary. You mentioned that it ends in the currency graveyard. How do we get to a currency graveyard if all the currencies are pursuing the same reckless policies? Who falls against whom?
Yeah, well, that's all of the currencies with the exception of one, which is gold. So to answer the inflation-deflation question, you have to actually first decide which currency are you going to use to measure prices. In other words, if you look at prices in terms of dollars, you're going to see a hyperinflationary blow-off, and the dollar will end up in the fiat currency graveyard that way. The hyperinflation will come because of continued quantitative easing by central banks around the world. But if you look at the price of goods and services in terms of gold, you're going to see a massive deflation. In other words, the purchasing power of gold will continue to increase in the years ahead, which is basically what happens during a deflation. The purchasing power of the currency increases. So we're going to have deflation when prices are measured in terms of gold, or inflation when prices are measured in terms of dollars or euros or British pounds or Japanese yen. So clearly everybody should be focusing on owning as much gold as possible within their liquidity part of their portfolio.
Well, I started accumulating gold in 2002, and I did it principally as a way to preserve my wealth, and it turns out it's also been a way to enhance my wealth for this dynamic you've described. And we're closing in on 10 years in my personal experience with gold, and in each one of those years, it has been a great way to not only protect my wealth, but also increase my wealth on a purchasing power basis. And you're predicting that dynamic is going to continue.
Yeah, and let's put it into a bigger term perspective, because what you've been witnessing over the past 10 years is just a recurring pattern that has occurred throughout monetary history. We have these what economists call booms and busts. During the boom, banks lend and lend and lend, borrowers borrow and borrow and borrow, until both banks and borrowers become over-leveraged, and then you have the collapse. You had the boom in the 20s, the collapse in the 30s, the boom in the 50s and the 60s, the collapse in the 70s, the boom in the 80s and 90s, and we're in another collapse. Now, when you're in a collapse, be it the 30s, the 70s, or this present period that we're in, you want to own gold because gold preserves your purchasing power during this financial reckoning. And when we get out of this particular financial collapse or bust that we're in, which is going to take a few more years, you'll then have your wealth and purchasing power preserved by owning physical gold, and you'll then use that gold to make investments, acquire consumer goods, because by that moment in time, gold's purchasing power will be at a maximum. Gold will be overvalued compared to where it's been these past several years, which is undervalued, and gold is still very undervalued. So, that's the bigger term strategy as to what everyone should be aiming toward and looking for.
Well, so let's talk about that. I'm interested in your timeline here. I was going to ask you when you think the wheels are going to come off, but it sounds like you're saying the lug nuts are off and the wheels are already wobbling on the axles here. So the question becomes, when do you need to have your core position in place before it's too late? Is it too late? It's a lot of people think that gold is in a bubble. It's already at it's really hard to buy at all-time highs, and I completely sympathize with that. But given where we are in this story, you said there's still a few more years in it. How many years and is now an okay time to begin establishing a core position if you don't have one?
Yeah, your question is a good one, and I get this one, all of the time. In fact, I've been getting it since I started GoldMoney back in 2001.
Uh-huh.
Is it too late? And my answer is, don't look at the price of gold, look at the value of gold, because that's really what's important. What's been happening over these past 10 years, the price of gold has risen, but the dollar has been being debased every year by policies that are destroying the purchasing power of the dollar. The purchasing power of the dollar is being constantly eroded by quantitative easing and all types of other things that the Federal Reserve and the government is doing. So the question is gold still good value? And yet, to answer that, you have to say, well, what does gold do for you? And what it does is it preserves purchasing power over long periods of time, and it does this when you own physical gold. It does this without any counterparty risk. In other words, the value in your gold is not dependent upon someone's promise. Now, what happens during a bust, like the one we've been going through, is promises get broken. The people who had money at Lehman Brothers saw that, promises were broken at Lehman Brothers. The people who own Greek debt, they're seeing those promises being broken. And this is going to continue recurring until balance sheets are brought back down to leverage, and we're nowhere near that. When I did an interview back in Barron's in 2003, and they asked me to forecast the price of gold, and I said it was probably going to be $8,000 an ounce sometime between 2013 to 2015. And I'm sort of sticking to that price target, and I'm also sticking to that time frame, because normally a bust lasts about anywhere from 10, 12, 15 years. So 2015 would be 15 years from the peak of the last bubble in 2000. Now, it could be longer than that if government continues to intervene and prevents the free market from cleansing, all of the bad debts and all of the bad decisions that have been made all along. We've probably been much closer to the end of that had the bailouts not taken place back in 2008 and let the system cleanse itself then. The people who had made right decisions would be doing okay. The people who had made bad decisions would be bankrupt. And as a consequence of that, we would be dealing with these ongoing problems in the banking system that we have today. So, if government continues to fiddle around and intervene, maybe it's going to be 6 years before we finally get to the end of this. But on the other hand, if we get a hyperinflationary blow-off in the dollar, and I think that, could happen here as well, maybe the end is finally going to come sooner when people start to realize that what we're addressing here is the point that you were raising. This is not a cyclical issue; it's a structural issue. It's a structural issue that there's too much debt, and the system of allowing governments to just borrow, and put the burden of that debt on the backs of taxpayers. That system has to come to an end, and I think that's what we're facing, presently in Europe. And we'll soon be facing in the States when that August 2nd debt limit decision is made.
I've been, one of the things that's truly surprised me so far, James, in all of this was how long we've been able to kick the can down the road. And you mentioned that one of the things that will happen is gravity eventually takes over, so maybe the timeline extends or contracts a little bit depending on the decisions that are made. I have one other thing I want to get your view on, which is that I see that the longer we kick the can down the road and continue to pile up the public debts, that the greater the risk we have of something even worse happening than might have happened otherwise. That is, I see a risk of the loss of the dollar's reserve currency, maybe in a fairly dramatic way, maybe transpiring over just a couple of months, something really dramatic. Low probability still in my mind, but it's now possible. And that I am growing more and more concerned that the more reality is attempting to be denied, I guess, with all of these policies, that the risk to the currencies is now growing larger and larger. And I don't have a really great way to quantify that yet, but it's certainly something that's very strong in my gut, and it's something that I think I've got a reasonable handle on, looking at historical examples and looking at how these things have played out. What's your view on the risks here?
Yeah, I agree with what you're saying completely, except I think the risk is much greater than just the dollar's loss of status as the world's reserve currency. The real risk when you have a currency collapse is ultimately political. If you look at the history of currency collapses, more often than not, you move toward dictatorship to totalitarianism. And just to give you a couple of examples, after the Weimar Republic collapse of the Reichsmark in the 1920s, it ultimately led to increasing fascism, and we all know how that worked out. But, I mean, look at the collapse of the French livre during the period of the French Revolution. It ultimately led to chaos and Napoleon. Now, if the U.S. dollar collapses, it's not the first time that a currency has collapsed in America. During the War of Independence, the currency was the Continental, and it collapsed because it was overissued. Politicians were spending too much money. Nobody wanted to lend to the government, and they put that they printed the currency and put it into circulation, what they called bills of credit at the time, but it was basically what we call paper currency. And because the Continental collapsed, one of the reasons why the framers got together to create a more perfect union was to create a common market with a common currency, much like Europe tried to do with its common market. And the common currency, of course, was the silver dollar, which was, confirmed. First of all, it was put in the Constitution, but it was reconfirmed in the Coinage Act of 1792, which was one of the first acts of the new Congress, which had just been created under the Constitution. And that system worked, more or less pretty well. There were some problems along the way, but it worked more or less pretty well up until, 1971, when the last remnants of precious metals were kicked out of the monetary system. And what those metals did is they put an external discipline on the spending by Congress. And without that external discipline, you run into problems. But getting back to the political issues I'm making, when you have a currency collapse, you can go the right way or you can go the wrong way. Germany went the wrong way. America, after the collapse of the Continental, went the right way. And I would hope if the dollar collapses this time, we'll go back in history and look and see where the heirs were, by abandoning the precious metals and get back on the right track.
Well, this is a subject near and dear to my heart now because I own gold for two main reasons. One is wealth preservation, and the second is I think there's an option value on it. And like all good options, this one's pretty far out of the money, but boy, it's got a really attractive strike price if it hits, and that is that gold and maybe silver might be remonetized at some point. That I truly believe we are at risk of a major currency failure, particularly in international settlements. And in a time of crisis, often what happens is you revert to the last thing that worked. Last thing I'm aware of in the international financial scheme that really worked was gold as backing. Do you see that as a possibility? What are your views on remonetization, and what might that look like, and how would that happen?
Yeah, it's a really good question, and it's basically what we intend to, or what we are doing really with GoldMoney. When you have money, you can do two things with it. You can save it or you can spend it. And right now, when it comes to gold and silver, most people are saving it rather than spending it. But within GoldMoney, based on the patents that we have, we enable gold and silver to circulate as a form of digital currency. Instantaneously, 24/7, anywhere in the world, completely outside the banking system. So will gold and silver, become currency, once again in the future? Just as an aside, you used the term monetization. Gold is money because it's still useful for economic calculation, and the same thing with silver. They were stopped by governments from circulating as currency, but they can still be used to calculate the price of goods and services. They still still our money, and that's basically why gold's value arises. It's from its monetary use, not from any other application. But in terms of having them circulate, once again, as currency, this is the interesting part. Are they going to circulate again as coins? I don't think so. I think they're going to circulate again digitally. In GoldMoney, for example, you can use your iPhone to click gold from your holding to someone else's holding. And I think ultimately a new form of gold currency that we're making available in GoldMoney will be how the precious metals will once again circulate, in commerce globally.
Well, sure. So that you don't have to flip bits of actual metal from one person to the other, but there would be in your system 100% gold backing for whatever amounts are being transacted.
Yeah, it's even better than backing. When you talk about backing, you're talking about banks where there's a liability circulating as currency that's backed by an asset on the bank's balance sheet. But in GoldMoney, you're actually using what is in effect a digital gold coin. If I put a gold coin across the countertop to pay for some good or service, the exchange is extinguished at the moment that I get the good and the shopkeeper gets the gold coin. There's no lingering obligations like you have in the banking system when you use checks or wire transfers or plastic cards. There's a lot of payment risk in the banking system. But with digital gold currency, the gold and silver remain in the vault, and you just click the ownership of whatever weight you're transferring from your holding to another person's holding. So it's extinguished at the moment that you receive the good and you click the payment to the other person's holding. It's like a gold coin, but you're not bound by any physical location. It's the gold and silver remain in the vault, and the ownership of that gold and silver is being transferred instantaneously.
I really I love the whole concept, and it appeals to me greatly. Now, I want to shift here to talking about investing in precious metals. So you mentioned before a portion of someone's liquid assets definitely should be in gold and silver. Absolutely a song I've been singing. Let me get this from you. What would your percent portfolio recommendation be? Maybe there's a range you have given where people are in life, but what's that percentage for you?
Yeah, it's hard to make a sweeping generalization, Chris, because everybody's circumstances are different.
Yeah.
And, what might work for one person may not work for another person. Age is a big factor. The older you are, the more conservative you should be, so the higher percentage of gold you should actually have in your portfolio. A younger person may want to be focused less on savings, having less liquidity, having less gold and silver, and more in investments, maybe mining companies or tangible assets like timberland and other types of things, other types of tangible assets that produce cash flow. But the older you are, the more gold you basically want to have in your portfolio, and so that by the time you're in your 70s or 80s and near the end of your life, I would tend to think you'd probably be getting closer and closer to 100% gold to make an easy transition of any assets you want to distribute to your heirs, as well as to have liquidity available for any needs that you might want to have to make your retirement years as comfortable for you as possible.
Yep. And so so for me, I have I think everybody ought to have at least 10% exposure as a start. I'm much higher personally, and but I totally recognize and understand and support the idea that individual circumstances vary a lot. But assuming somebody wants to build some exposure, starting even now, here with gold at 1,500 and I guess, I don't know, what is it today, maybe 35 or something, how would they go about doing that, given that, where gold is today? How would you personally coach somebody to build their portfolio?
Yeah, the best way to do it is through a dollar cost averaging program. In other words, determine what portion your portfolio you want to put into gold. And then divide it by, 6 or 10 or 12, some number representing months at which accrue or accumulate. Maybe you want to do it in just over 3 months. So you decide that, let's say, for example, you have 100,000 that you want to put into gold, and you want to do it over 4 months. So you divide that by 4, you've got $25,000, and you choose to make the purchase on, for sake of argument, the 20th of each month. So regardless what the price is on that on the 20th of the month, on the first month you buy 25,000 on the 20th of the month. The second month another 25,000 on the 20th month. Third month and fourth month you do the same thing, regardless what the price is, and you will have averaged in. Because what we're talking about here, Chris, is a major bull market. And one thing that a bull market does is, regardless when you buy, that you're going to come out whole, or you're going to have your position improved as the bull market continues to move forward. And that's why I come back to this point about the difference between price and value. You know, the price of gold may seem high, but the value of gold is still, by all of my historical measures, very, very low. In other words, gold is still very undervalued. So as this bull market moves further, the price will go up, but and it will become less and less valued. But you know, we're still years away from gold becoming overvalued.
So let's somebody's done this. They're putting in 25,000 on the 20th of every month. They're fortunate enough to be able to do that for 12 straight months. How do you recommend allocating among? There's all these various ways of owning precious metals. You know, we've got gold in hand. Maybe you got coins or bars or ingots or junk coins in the case of silver, numismatics even. Where you buy it from, how you would store that kind of stuff, compared to say allocated storage or paper gold or miners you mentioned. Maybe there's other derivatives. How would you advise somebody to sort of structure that if they're, let's say they're just starting?
Okay. Let's first look at it from a big picture point of view. When you have your portfolio, you have two different asset groups in your portfolio. You have investments and you have liquidity. You know, your investments are your wealth-producing assets. You put your money at risk in order to generate some kind of return. And then you have your money, your liquidity, where you've either sold an investment and you're waiting to make a new investment, or you sold an investment and you're waiting to make a purchase of some kind of consumer good. Gold mining stocks are an investment. You know, they have to be treated like all stocks. You have to look at management, the quality of the balance sheet, the quality of the company, and all those types of things. But bullion is not an investment. It's really money. So you have to compare bullion to other monetary alternatives, you know, like the dollar or the euro, or, you know, wherever you happen to live. Now, in an environment where you're not earning any interest income on your dollars, as is the present case, you may want to have a much larger holding of gold because there's no cost of holding gold. And in fact, because gold has been going up in dollar terms 18% per annum on average for the past 10 years, you're much, much better off owning bullion than owning dollars in this environment. So, you know, the broader sense is, investments are your mining stocks. Bullion is your liquidity position. Now, looking at gold, you know, people say they own gold, but when you actually analyze it, they don't really own gold. They own paper gold. Paper gold is different from physical gold. Paper gold are the various representations out there where you are exposed to the gold price, but you don't actually own metal. And that exposure to the gold price comes with counterparty risk. You know, options and futures, and you know, even the ETFs. They're basically paper gold products because you don't own physical gold. You own a stock of a fund that supposedly owns gold on your behalf. What I recommend when it comes to the bullion part of your portfolio or liquidity part of your portfolio, you own physical gold. And there are only two ways to buy physical gold. You buy it and you store it yourself, or you buy it and you have someone store it for you, which is what we do in GoldMoney. Now, each approach has advantages and disadvantages, just like anything in life. You got to weigh the pros and the cons and then make some decision that best suits your needs. When you buy it and have it at hand, store it at home, you have it right there at hand, which is an advantage. But that comes with disadvantages too. You know, what's the risk of theft? Can you get insurance? Is the insurance expensive? You know, if you have to sell to get because you need the money, you have to take the coins or whatever they are back to the shop. If you own bars, that might force the bars to be refined, and you incur that cost. So there are disadvantages to storing it yourself. Also, if you store it in a bank safe deposit box, there's the risk of confiscation. I mean, gold was confiscated in 1933. Who's to say it couldn't happen again in the future? If you store the gold with others, There's also advantages and disadvantages. The disadvantage is that you don't have it in hand, but there are advantages to, like gold money. You have the gold stored for you outside of the United States, which is useful because when the gold was confiscated in 1933, gold held by Americans outside the United States was not confiscated. Whether that happens again in the future, who knows? But it's worth noting the historical, precedent for it. The other thing is that it's in a secure bullion vault. It's insured, but most importantly, you have very good liquidity. If you need the money for some reason, you can sell your gold or silver and have the money wired to your bank account, the proceeds wired to your bank account, the same day. So what you basically have to do is look at these different alternatives between buying and storing yourself and buying and having someone store it for you, and see what, or probably both, methods make sense. If you're going to store $5,000 of gold at home, that's one thing. You might be prepared to take the risk. But you're obviously not going to store $100,000 of gold in your basement. It just doesn't make any kind of sense. So, what you have to do is make the decision between these two alternatives. But there is one thing to keep in mind, Chris, that if you're using other people to store your gold and silver for you, there are certain things that you have to be careful about. You have to make absolutely certain that your gold and silver are there in the vault. And the only way you can do that is to have independent third-party audits. And you have access to these audited reports showing that the weight of gold and silver in the vault is exactly equal to the quantity of gold and silver that you own. And this is one of the backbones of gold money. So what I basically recommend to people is if they're looking to store at others, make sure that you have the same industry-leading governance principles that we follow in gold money, so that you know that your gold and silver stored with others is not at risk.
Excellent. And if people want to find out more about that, they can go to GoldMoney.com, and you've got a great website there, and it explains a lot. And what I've heard so far is that gold's in a major bull market here, and there are probably several years left to it. And kind of in the near term, what we're looking at is that QE, that is the printing of money, both in Europe, whatever they call it, and in the U.S., is really set to continue. And by the way, it'll continue in Japan as well. So we have more and more debasement of money in a vain attempt, in my opinion, to sustain the unsustainable, which was a credit market that went too far. So here we are, and it looks like for a variety of reasons, there's time left in that particular story. You've set a target that, we can slide the date a little bit depending on what policy decisions get made, but that 8,000 gold is not an unthinkable number to you. That remonetization lurks as an international policy option at some point across major nations, and that it already exists as money through GoldMoney.com for individuals to use and to trade it, use as money. So that's where we are in the story right now. And what I'm interested in hearing from you is about, so let's assume somebody has a big PM position, a big precious metal position. How would they protect that? Or do you advise protection? Limits, stops, options, futures, offsetting positions. Do you at all get involved in any of that?
I don't recommend trading the precious metals. Making money by trying to pick the fluctuations correctly in the price of gold or the price of silver is a very, very difficult full-time job, best left to professionals and speculators. The way you want to preserve wealth is to accumulate an asset that's undervalued, continue accumulating it throughout the bull market, and when the bull market is finally over and the asset becomes overvalued, then use that asset to invest in other things that become undervalued at that future date. So that's really my approach. And, gold is the insurance. I don't think you need insurance when it comes to gold or silver, for that matter, because they are so undervalued. The insurance that you need is the insurance of being reliant upon the dollar, because it's the dollar that's overvalued and overowned and existing because of its legacy, not because of its present underlying fundamentals. The present underlying fundamentals suggest that the dollar should be much, much lower and gold should be much, much higher. And I think it's just a question of time for the market to perceive that. And that's what it's been happening over the past several years, and I think it's going to continue for the foreseeable future.
I have this brings me to a something very near and dear to my heart, which I personally have an exit strategy for precious metals, and I'll know when that day comes. And it's a ratio for me, and I'll share that in a minute. I'm wondering, tell me about your exit strategy. You've mentioned, at some point gold will be overvalued. Will you know that by price? How will you detect that? What are your signposts there? And what would that look like? When will you know it's time to begin reversing that trade?
Yeah, I have some mathematical models. There's a lot on the internet about my fear index. Once my fear index gets into a high territory, that'll be a clear warning sign. But there's really a very simple approach I think everybody can follow, and it's a response I give to a question I get frequently. People say, if I buy gold, how will I know when to sell it? And, they're immediately thinking about January 1980, which is the peak of the last bull market, 2020 hindsight, how can I pick the top? And I think that this time around it's going to be pretty easy to pick the top because you're not going to sell your gold, you're going to spend it. Now, think about what I'm saying there. What I'm saying is that gold is once again going to become currency. Once gold becomes currency again, it's going to become overvalued. You're going to want to use your gold and to buy consumer goods, houses. Use your gold to buy, farmland, office buildings, stocks, all kinds of investments that you can think of that are undervalued at some point in time in the future relative to gold itself. So, gold is going to reemerge as currency. And I think the 20th century, or let's say the last half of the 20th century, or maybe even just the last few decades of the 20th century, are going to be an aberration in monetary history where people largely thought that gold had no role to play. But when you start to consider that gold has been money for 5,000 years, and we've only been dealing with the world's reserve currency without backing by gold for only 40 years, and given the problems that we're seeing today for the dollar, one has to assume that gold's rightful role at the center of global commerce is going to reemerge once the silliness with fiat currency and government printing presses ends, which I think is going to be happening within the next few years.
Well, you mentioned August 2nd as a date to watch because that's when the debt ceiling gets bumped up by a couple trillion. I'm watching August 15th because that means this is the 40th anniversary. I love round numbers when it comes to these things. The 40th anniversary of the slamming of the gold window. And when we look back historically, there are a lot of currencies that failed, including even metallic currencies, through the process of actual debasement or clipping. And 40 years is not an unthinkable amount of time for a currency experiment to run historically, and so here we are. And the idea that the dollar can continue in its current role for another 40 years is actually a really, really tiny probability to me. I'm seeing larger stresses, increasing structural imbalances, an absolute failure of floating exchange rate fiat currencies to manage international trades in goods and services in any reasonable fashion. So all of these things are building, and here we are. And one of the concerns that comes up for many people, many of my listeners, I'm wondering if you could touch on this now, is so they accumulate this position in gold because they read all of these tea leaves right, they've got their position, and then all of a sudden the rules get changed, and the gold either gets confiscated, kind of a funny word, as it did in 33. I mean, actually, they gave you dollars in return for it, so it wasn't like a full a complete confiscation with no return. Do you see what do you see as the risk of such an event? Maybe it's too broad. Maybe that'll vary by location. Certainly, probably well by country. But what are your views on that confiscation fear or worry, or the idea that gold will be appropriated or be declared an international reserve asset? Therefore, it's too important for people to own individually. It belongs to the nation or the globe. What are your views there?
Yeah, it's really sort of sad that the big risk today to owning gold is government. Government is supposed to be there to maintain the rule of law so that we operate in a level playing field so that no one person is at an advantage to another person. And, the key to that is protecting property rights. This is the basis of traditional Anglo-Saxon common law. Over the last decade or two, we've moved so far away from that. A lot of what's called law today is hardly recognizable in terms of historical precedent and the traditions built up through traditional Anglo-Saxon common law. But government has become the big risk today for anyone who owns not just gold or silver, but in many respects any asset. This is sort of unfortunate, but it's a sign of the times and what we have to deal with. I think the only answer that one can pursue to deal with increasing lawfulness that governments are pursuing, or unlawfulness in terms of historical standards, is global diversification of your assets. Just try to buy as much as you possibly can, because when you do that, you're mitigating risk. There's no one right answer. Because the future is unknowable, there's no one right answer as to how to plan for the future other than diversify. Diversification mitigates your risk, and I think that's the thing that everybody should be keeping foremost in their mind.
I absolutely agree with you. It is awkward at this moment in time to see some of the changes that have happened and are continuing to happen, and it's all accelerating. And this is a point of view I have, which is that things are going to speed up. We're at a really unusual moment in history. We've been sticking to just the economic side. There's a really interesting story when we put energy into this mix, and the notion that we have a world economy, a money system that really needs to expand to be happy, and there are real adult-sized challenges to expansion as we've known it in the past. And it's unclear to me how those are really going to play out, but I am convinced that how things used to work is not how they're going to work in the future. And so we're now describing that there'll be potentially a change in government and policies, maybe a change in leadership that could accompany a hyperinflationary collapse of some kind, a la Weimar Germany leading into World War II, in essence. That there are many of these risks. I see a well-diversified portfolio in gold and silver as a reasonable way at this point in time to protect as best we can, knowing that we don't know what's going to happen or how this is going to unfold, but we do the best we can. The rules have changed, though. The old rule of having a reliable yardstick that we could count on and measure things by, which we used to call the dollar, or in the euro, depending on where we live, that's really shifted, and we're in the period of that shifting, and that makes it really challenging, and it's difficult, and it's uncomfortable, and it's awkward, and I find in many cases people become paralyzed through all of that change, and my advice has always been, as soon as you get that first gold coin in your hand, first of all, you're going to connect with 6,000 years of human history, which is magic, and the second thing that's going to happen is you're going to start feeling that first bit of relief of saying, I now own the only monetary asset known, which is not simultaneously somebody else's counterparty risk, which you've already mentioned. One of the great reasons I believe in owning this particular monetary asset of gold.
Yeah, I agree with you completely, Chris, and I think what you said is very well stated. You've hit the nail on the head, and captures exactly the reason why people should be looking at the precious metals.
Exactly. So, as we close up here, tell me, are there any best-kept secrets out there? I mean, what do you see as the least understood aspect, maybe pro or con, of owning precious metals? I mean, let me put it this way: what advice would you give to kids today if they were going to buy into this market?
There are a couple of keys. We've already discussed some of them, like buy physical metal and not paper gold or paper silver. You want physical gold and physical silver. But there is another important key. You want to get the most gold for your money. In other words, you want to look at the cost of buying that gold relative to different alternatives. You want to get the smallest markup over the spot price of gold. And to do this, they're typically, the larger the bar you buy, the lower the cost to you. And this is because smaller coins or smaller bars have fabrication, shipping, and handling costs, and they can be quite considerable. So, for example, if you're buying a 1-ounce coin or several 1-ounce coins, you might be paying 7 or 8% over spot. If you're buying a 1/4 ounce coin, you might be paying something like 15 or 20% over spot, because the cost of fabrication is a much higher percentage of the smaller gold content in a 1/4 ounce coin than it would be in a 1-ounce coin. And this logic continues to follow all the way down to 400 ounce bars, which is the international standard, which is what we sell in GoldMoney, as well as parts of a 400 ounce bar. So you can buy gold and silver in GoldMoney for nothing greater than 2.5%. You can buy $100 worth of gold for $102.50, and you can't buy physical gold any other way for such a low markup over spot. So what you basically want to do is to get the most gold for your money, and the way you have to do that is to get the largest bars possible when you're making your purchase.
Excellent. It's always the bid and the ask in that whole transaction. So there are transaction costs to gold and silver, as you mentioned. But when people trade it between themselves now, they're in the GoldMoney.com system and they trade it. Where are they trading it at the ask, or are they trading it at gold spot, or how does that work?
Yeah. First of all, if you are a Gold Money customer and you want to sell some gold and convert it into U.S. dollars or euros or some other national currency and have the money wired to your bank account, you get the spot price of gold. So we don't take any fees when you're actually selling. And the reason why we've created Gold Money that way is we don't want the fee to be an impediment to liquidity. You know, if you need the gold or you need the silver, go ahead and sell it and and don't pay a fee for it. If people are actually using it between themselves, they can do it one of two ways. They can either agree to doing a contract between themselves in terms of ounces or grams of gold or silver, or platinum and palladium for that matter too, because we offer those metals as well. So, for example, let's say you and I have a business deal and I agree to pay you 3 ounces of gold. I just click 3 ounces of gold to you. On the other hand, let's say you and I have a business deal and I agree to pay you $4,500, and you are willing to accept gold in Gold Money as a form of payment. On the day that I have to pay you, I go into my Gold Money holding, put in $4,500 as the amount to be paid. What is the gold equivalent? Based on the spot price at the time that you're actually making the payment. And that weight of gold is then clicked from my account to your account and transferred instantaneously. So you can actually do it that way. We actually are using 16 different currencies in Gold Money for tracing back to the spot price when you're doing an exchange, using it for purchases or sales with someone else within the Gold Money system.
And is this useful for small dollar amounts? I mean, how many decimal places to the right do you go when transferring gold? Yeah,
we go down to what we call a mil. A mil is approximately equal to 4 U.S. pennies. I mean, we could always go down much further because once you digitalize it, you can take it to as many decimal points as you want. But we find that 3 decimal places works very, very well, and it's something that people are very familiar with. We also operate in terms of ounces. We show your weight of gold 2 ways, either in metric or in troy. So regardless whether you're European or British American, you'll be familiar with what you have in terms of how much metal you own. And you can also report for your own internal purposes a reference currency. So if you have a specific weight of gold, you can see when you log into your holding what the value of that gold would be in terms of your reference currency that you choose.
Excellent. Well, I really want to thank you for today, and I know that you have a lot of writing out there, and other you've got your fear index, all of the wonderful work you're doing to help educate people. How do people follow you, and how do they find out more about maybe your fear index or other things that you are sharing with the world?
Yeah, look at GoldMoney.com. We've got a big research section there. I contribute there as well as other people, contributing there from time to time. I also have a number of videos where I've interviewed money managers and things like that people find useful. And if you have specific topics like the fear index, just Google fear index James Turk, or just Google James Turk, and I'm sure you're going to see some articles on the fear index. And then they'll just continue to lead to other articles as well on the fear index. So that's probably the best way to do it.
Well, excellent. So thank you so much for your time today. This has been very helpful, and I'm sure people will get a lot out of it, as I have. So thank you again, and it's been my pleasure.
Thanks, Chris. It was a pleasure speaking with you.
This concludes this podcast by Chris Martenson. To gain further insight into where things stand today and what might happen tomorrow, please visit chrismartenson.com. That's ChrisMartenson.com. Please join Chris Martenson next time to continue your journey toward awareness, understanding, and action.